Hello my dear friends and welcome to StudyIQ. Today in this lecture we will discuss about Sensex and BSc, and we will also see the most important current affair that is related to Sensex, that is the benchmark Sensex at the Bombay Stock Exchange has risen to a 7-month high during this month. So we will also analyze what are the reasons for this rise in the Sensex over the last 7 months. So we will analyze in depth what are the reasons, and also we will see what is Sensex and what is BSc. But before we begin, this is our channel StudyIQ, and we are providing pen drive courses for various competitive examinations including SSC and bank courses, UPSC optionals, SSC JE courses, teaching examinations, railway examinations, defense examinations, RBI grade B, NABARD grade A, UGC NET, UPSC Civil Services Examination, CLAT exams for various state PSCs, and also for various professional courses. You can visit our website www.studyiq.com for more details, or you can call to any of these numbers for more information. We have already discussed what is the current affair. The benchmark Sensex at the Bombay Stock Exchange has risen to a 7-month high. So in this context, let us first understand what is Sensex. So Sensex is basically stock market index of BSE. BSE stands for Bombay Stock Exchange. So the stock market index of BSE is known as the Sensex, and it is launched by the Bombay Stock Exchange. Now, what does the Sensex do? Sensex evaluates the fluctuations in the stock prices of 30 companies. So, any variation or any fluctuation in the stock prices of the top 30 companies or 30 big companies is evaluated by Sensex. So, this 30 companies are 30 big companies in terms of market value, turnover and profit. Now, the Sensex will evaluate any fluctuation or any change in the stock prices of this 30 companies. Now, a rise in the Sensex, that means a rise in the value of Sensex, denotes that the stock prices of most of the companies in the BSE is increasing. So, overall there is an increase in the stock price of most of the or a majority of the companies in BSE. Now, if there is a fall in the Sensex, it means that the stock prices of most of the companies in the Bombay Stock Exchange is decreasing. So, a reduction or a fall in Sensex will indicate that there is a fall in the stock price of the companies in the BSE. Now, we have seen that a 7-month high in the value of Sensex has been recorded. It means that the price of a majority of the companies listed in the Bombay Stock Exchange is increasing. Now, the base value of Sensex is 100 and the base year of Sensex is 1978-79. So these are the basic facts about Sensex. Now moving on to Bombay Stock Exchange, let us understand some basic facts for Bombay Stock Exchange which will be helpful for your competitive examinations. So Bombay Stock Exchange is the oldest stock exchange in Asia, and it was formed by 8 Native Brokers Association in 1875. So it was formed in 1875 and it is the oldest stock exchange in Asia. And in the year 1927, Bombay Stock Exchange received a temporary approval from the government of Bombay. Again, a permanent approval was given by the Indian government in 1957. So in 1927, that was before the independence, a temporary approval was given to Bombay Stock Exchange, and in 1957 the government of India granted permanent approval to Bombay Stock Exchange, and now Bombay Stock Exchange is the 10th largest stock market in the world by market capitalization. So in terms of market capitalization, Bombay Stock Exchange or the BSE is the 10th largest stock market in the world. And in Bombay Stock Exchange, now there are more than 5,000 companies listed on it. So 5,000 companies have listed in Bombay Stock Exchange and they are selling their shares through Bombay Stock Exchange. So this is briefly about Bombay Stock Exchange. Now coming on to the current affair part, we have seen that the benchmark Sensex at the Bombay Stock Exchange rose to a 7-month high. Now let us analyze what would be the factors or reasons for this rise in the value of Bombay Stock Exchange or the Sensex. The first and the major reason for this is strong FDI flows into the domestic equities. So this is the major reason. Now let us understand what is FDI and what is domestic equities. The first and the major reason is strong FPI flows into domestic equities. So it is the most important reason why the value of stocks or the price of stocks on the Bombay Stock Exchange has gone up. It is because there was a strong FPI flow. It is FPI, foreign portfolio investment. Now let us understand what is FPI and what is domestic equities. So coming to FPI or the foreign portfolio investment, they are securities and financial assets passively held by foreign investors. So they are not active investments by foreign investors, but they are passive investments made by foreign investors. So here, why it is called passive investment? This is because the investor does not have direct ownership of the financial assets. So the investor will be purchasing stocks, bonds, financial assets, etc. in a foreign country. That is why it is called a passive investment, and this is shown as a part of the capital account of the country. So FPI or foreign portfolio investment falls under the category of capital account, and this is shown as a balance of payment in capital account. Now, how does FPI differ from FDI or foreign direct investment? Under FDI or foreign direct investment, the investor purchases direct business interest in the foreign country. For example, the investor will make investments in infrastructure, capital, technology, manpower, etc. So it is called an active investment. The other one, FPI, is called a passive investment, while FDI is called an active investment because the investor purchases direct business interest in the foreign country. Now, if you compare FPI and FDI, FPI is considered to be more liquid. This is because the investor has a choice to take back or withdraw from his investment at any point of time. But FDI is not very liquid because the investment is in the form of technology, infrastructure, manpower, capital, etc. And there is a direct interest in the day-to-day functioning of the company. So, being an active investment, FDI is considered to be less liquid. The liquidity is very less. So FPI or foreign portfolio investment is more liquid, whereas FDI is less liquid. Now coming to the risk part, if we analyze the risk component of FDI and FPI, we will see that FPI has lesser risk for the investor. That is because here the investor is only a passive investor. So he invests or purchases the stocks, bonds or financial assets in a foreign country. So being a passive investor, the risk is less for foreign portfolio investor, whereas the risk is high for foreign direct investor because the investment is in direct form. So the risk is high in case of FDI and less in case of FPI. So these are the basic facts about FPI, and the most important reason for the rise in the benchmark Sensex at the Bombay Stock Exchange is due to strong FPI flows into the domestic equities. Domestic equities means the equity shares of the domestic companies or Indian companies. So there was a increase in the FPI flows to domestic equities or to the shares of domestic companies. Now the second reason is inflow from domestic investors through mutual fund route. First we talked about foreign investment in the form of foreign portfolio investment. Now the second one is domestic investment. That means the investment from domestic sources, and the major source of domestic investment is mutual fund route. So there was an increase in the inflow from domestic investors through the mutual fund route. So mutual fund is basically a pool of investments collected by a investment regulator or a investment manager from small individual investors. So a rise in the domestic investment through mutual fund route also caused to a rise in the benchmark Sensex. Now third reason is because of the stability of the currency or Indian rupee. So stability of a currency depends on the value of the currency. When the value of the currency goes down, it is called depreciation of currency. So when does the value of a currency go down? It is when there is lesser demand for a particular currency. So when the demand of a currency comes down, the value also goes down, and this will lead to depreciation. And again, if the demand goes up, it means that the value will go up, and this will lead to appreciation of domestic currency. For Indian currency, that is rupee, there is a stable environment for the last few months, and the stability in currency is one major reason for increase in the benchmark Sensex. So if there is a instability in the domestic currency, foreign investors would be reluctant to invest in the foreign market or to make investments in another country's share market. Now, stability of Indian rupee is also one major reason why there is increased investments, and therefore the benchmark Sensex has risen. Now, another indirect reason is the stability of the prices of global crude oil. Now, this has a direct linkage with the stability of currency. This is because India is an import-dependent economy for crude oil, and its fuel demands or crude oil demands are majorly met through imports. So, when the prices of crude oil increases, there is a direct impact on depreciation or the value of Indian currency. So, when prices of crude oil increases, this means there is decrease in value of Indian currency because there is increased import bill, and therefore it leads to depreciation of currency, and the vice versa also happens. So stability of Indian currency is directly linked with the stability of global crude oil prices, and the stability in global crude oil prices for the past few months has also contributed towards stability in currency, therefore increase in the foreign investments, and thereby the benchmark Sensex has risen. So these are the major reasons. You can find the PDF of this lecture on my Facebook page, and you can follow my Facebook page for my video updates, and you can also write to me on joycey.studyiq@gmail.com. Thank you.